I'm going to pass it on to John Zagula at this point.
Tom, again, I wanted to thank you for that introduction and also for the thought-provoking data and insights that you had, including your urgent call to arms to make sure that we all have the needed cash for both operations and investment, not only to survive, but also to plan for real growth when that's available. Now, to help explore the dynamics of finding and directing this fuel are three panelists who source and deploy capital in a range of sectors, asset classes, stages, and categories. Scott Moses, Managing Director and Head of Grocery and Restaurant for PJ Solomon. Alan Yang, the Chief Investment Officer of GLP Capital Partners. And Kellan Carter, who's a partner at venture capital firm Ignition Partners. So just to kick it off, could each of you give me a quick intro of yourselves and the areas that you focus on? And let's start with Scott, and then I'll work on my video.
Okay, good afternoon, everybody. So my name's Scott Moses. I lead the grocery and restaurants advisory practice at PJ Solomon, which is the M&A advisory firm based in New York City. I advise management teams and boards on strategic alternatives and executing mergers and acquisition transactions, sales, divestitures. And I've been focused on doing that work mainly in the grocery sector over nearly 20 years.
Great, thank you. So Alan, you want to do the same? Give us a little brief introduction.
Sure. Hi, everyone. Alan Yang, CEO of GLP Capital Partners. We are primarily a logistics real estate private equity firm, but we also participate and invest in the broader logistics ecosystem, including technology and logistics related operating businesses, as well as adjacent asset classes to your traditional warehouses. We're also an investor with Tom and Justin.
Terrific. And lastly, Kellan, you want to tell us a little bit about yourself and about Ignition Partners?
You bet. Hi, everyone. Thanks for joining. Kellan Carter, I'm a partner at Ignition Partners. Ignition is an early stage enterprise software focused firm, primarily Series A with offices in Seattle, where I'm based, and also the Bay Area. Our general mandate is to invest in software companies that automate the modern economy, which is intentionally broad. And within that, I have a particular focus on companies that are building software that reinvent supply chains and automates back office operations. So essentially, the more boring the bar talk, the better for us.
So I'm not sure I would call it reinvention boring. I think it's obviously it's one of the important topics we're here to talk about today. Just to note, I'm reinventing myself as a blade of grass because I can't make my video work. You know, there's a recent article in The Economist that was titled Creative Disruption. The Pandemic is Liberating Firms to Experiment with Radical New Ideas. Now, each of you either have portfolio companies, clients, or partners who have been affected by this crisis. And kind of like Jim Donaldson talked about, stories are really important. So I would love it if you could each share a story of a company, a CEO, or an operation, and both the challenges that they've recently faced and then how they've responded, adapted, experimented to meet that challenge and to change, again, with the mindset of being ready to get the fuel they need to keep going into the future. And so why don't we start here with Alan?
Sure. So we have about 20 portfolio companies now, and I mentioned the technology and operating business side of our investment practice. And so a number of them have good stories to share during all this, but one of them in particular was Ben Hubbard at Parcel. He started his career as a bleeding heart in public service, doing sort of relief efforts in Haiti after the earthquake, and then getting vaccines to Africa. And he started an IoT device business to track cargo, and originally intended to preserve the provenance of vaccines with his device. But the opportunity for him evolved into something much bigger, cargo more broadly and perishables more broadly. And so he was pursuing this strategy pre-COVID. He created an insurance project, a product out of it because of the data available. And when COVID hit, the cargo shippers were not as sort of speculative with their new product acquisitions. The insurers' rates were going through the roof and were not willing to sort of provide competitive rates, even with his product. And so he, at the early stages of the crisis, was starting to face some pretty existential questions about everything he had worked for. And about sort of 3 weeks into it, you know, a light bulb went off for him, which was, you know, what was his true mission and his value-driven mission for his business. And he remembered this passion he had for helping others, and truly in this pandemic, the importance or the future importance of a vaccine for the world. And really, that's going to probably be the largest humanitarian logistics problem in the world to solve for the next 2 years, how to get 8 billion vaccines around the world. And so, you know, he shifted into reaching out to all of his prior contacts and reestablishing channels to work with, you know, being the back end support of the day when a vaccine actually is developed, or even just treatments generally. And so an odd thing happened. He started getting grants from the Gates Foundation. He started getting grants from the Clinton Foundation. The Financial Times reached out and did a feature article on him instead of just a sort of quote about shipping insurance. And that sort of conversion back to being mission driven and refocusing on his fundamental values, I think has been very valuable for him and his team and his leadership in this crisis. And it's not like a disingenuous thing of capitalizing on the pain in the world, but actually his business is thriving because of that. And that, I think, is a good story to share in this crazy environment we're in. You know, it's making lemonade out of lemons and all that. But the idea of, you know, refocusing on your, you know, first premise missions and values has served him well.
So thanks for sharing that story, Alan. I mean, I think it reinforces one of the themes we heard from Jim of, you know, digging deep on both a personal and professional level. And it's not just de-investing to reinvest, it's refocusing oneself. So thanks for sharing that. Scott, how about you? Anything in anybody or company in your universe that has a story that you want to share?
So I'm going to be a little bit more general. I get in trouble when I start identifying specific companies, given I'm in the merger business.
Yeah,
so, but I do spend, as I say, nearly all my time with grocers. And you can imagine what it must have been like for the average CEO around the country 3 months ago, 2.5 months ago, when they realized they had to go from feeding roughly half the country for any given meal to basically feeding the entire country. Nearly 330 million people, 21 meals per week. So you do that math, that's nearly 7 billion meals per week. Basically having to double your output, double the work that your in-store team's got to do, double your supply chain, and do that in a way where you're keeping your team safe and your customers safe in the midst of a panic, right? And when you think about what these teams have done, recalibrating the supply chain, working with food service distribution to get supply of meat and other products when the country desperately needed it, working through all these different safety changes you've seen throughout the stores. And many of the folks who I know have come to me, and we don't talk about this all the time, but a couple people have said, you look at the virus rate, the infection rate in my town, well, it's much lower for my employees, which is a kind of stark thing when people tend to focus on and have focused on grocery stores as a place that might be less safe. The fact is they're actually more safe because of what so many teams have done around the country to make them safe. And I think it's just heroic what people have done. I often talk about how grocery stores, supermarkets are pillars of thousands of American communities, right? Think about what they've done here for all of us over the past 2+ months. I personally have never been more proud to be associated with the sector.
You know, thanks for this. I think something all of us should remember is these things that we have taken for granted as sort of mundane daily occurrences are now we're reminded how deeply vital they are to us. So thanks for sharing that. Kellan, how about you across the portfolio or, you know, with other folks that you know, are there stories that can be very different that you think would be helpful to underscore this de-invest to reinvest, but also just adapting and changing?
Yeah, John, and I can identify a specific example because I'm not in the merger business. But one company in particular is called BotKeeper, and we led the Series seed round back in October of 2018. And the company was born to automate back office bookkeeping for SMBs. Over the evolution, so the core genesis of the company was always to serve the SMB market. Over the evolution of the company, it started to develop a partner offering where it would sell its partner, their software platform, to CPA firms so they could better service their clients. So when COVID started to happen, the company, it became real clear that they were worried about a lot of their SMB accounts paying. They also saw an accelerated demand from the partner channel, the CPA firms, to automate their digital workflows for a remote environment and also take out some of their back office costs to better serve their clients. And so they took 100% of the direct SMB resources and refocused those to the partner ecosystem and have seen accelerated demand because of that. And so it was really pivoting from what the entire genesis of BotKeeper was and doing a slight pivot to focusing on what is working in the current market environment.
Thanks again. I mean, those are all really, really interesting stories. They each give us some lessons that I think, you know, we need to keep in mind that will, you know, maybe not just in this crisis, but on an ongoing basis, you know, kind of staying aware of those opportunities out there is critical. So back to the topic of cash and capital, there's another Economist article that claims investment in innovation will actually plummet, citing, which I was aware of back in 2000 to 2009, VC funding fell by 30%. And now it may be even more challenging to secure capital if you can only pitch over Zoom, which is a pretty different mode. And that innovation is only going to come from exceptional big firms and small firms that already have money. So what I'm curious about is fundraisers and investors yourselves, what are you seeing out there in terms of capital sourcing and capital deployment, and what do you predict? Do you think funding is still going to be available? Where and in what form? And I think for many here, any advice on how best to go get that funding? I'm going to start with you, Kellan, because you were just talking about innovation and specifically some important technology innovation, and often with early stage companies. Where do you see funding today and in the future?
It's such an interesting question with so many caveats, John. If you think about the way VCs have historically operated, they generally have their investment prospects come in on a Monday where everyone's in the same room. They have the pitch, and then they debate whether or not they want to take a shot at winning the deal. And so VCs that are now having to make decisions in a remote world is the first time for them. So a lot of firms haven't really figured out what that means to them yet. Also, the first thing the VC firms did when COVID hit was took stock of their existing portfolio to make sure the companies were well capitalized to endure however long this may last. So as you think about how VCs make decisions, a lot of times it's important to have gotten to know them before this COVID thing hit, so they were familiar with you and comfortable making an investment decision. Because again, the first thing they're doing is taking stock with existing portfolio companies, then having a smaller set of limited priorities on the deals that they're going to pursue in a time like this. So I'm on the board of two companies, BotKeeper and Simen, that both set out to raise their Series Bs in February. And in both instances, the firms that led the Series Bs had met the entrepreneur in the Series A and had gotten to know them, so they were more comfortable making a decision remotely in today's environment. starting a new process with the VC firm remotely, having never met them in person, is a pretty challenging task given all the other priorities going on. It's not completely undoable, but it has gotten harder.
Scott, do you have a different perspective? I mean, you work in a different universe, and you also, maybe not just from pure capital raising, but from the standpoint of transactions, you know, what are you seeing happening, and kind of what's your outlook to the degree, you know, that you can put, we're not asking you to place some specific number, stake in the ground prediction, but that'd be great.
No. So look, Kellan just described a more microeconomic calculus. I'll talk about it on a little bit more of a macro basis, right? So funding for, certainly in my world, it's a relative concept, right? You know, you've got investment grade credits, you've got high yield credits, you've got folks who are owned or well capitalized by private equity, and then you've got venture guys. In any event, funding is about the relative cost of capital, right? Which is a proxy for a company's cost of customer acquisition and customer retention. About 65% of a company's credit rating, which determines its cost of debt, is determined by scale. The bigger you are, the better your credit rating in general. So take Walmart, $500 billion in revenue, AA credit. Take Costco, about 150 billion in revenue, A+ credit. Target, about 78 billion in revenue, A credit. Amazon, AA- credit, worth $1.2 trillion, give or take. 150, and that enables them to make investments that many smaller companies can't. So 150 million Prime subscribers, that gives them $18 billion in cash before they even sell anything. It enables them to invest in people, in marketing. Anybody notice a lot more Amazon commercials over the last few weeks? There have been a lot. And so they're investing there. They're investing in technology. And of course, they're always investing in growth. That's how you build a business. So when they went and invested $1 billion in next day delivery, that cost them, relative to their market cap, 8 basis points, 0.08% of their market cap. It may work, it may not work. I think we'd all agree it's changed the game. It's forced everybody who wants to compete with them to recalibrate. And so that, from a macro perspective, are the dynamics that are occurring across the grocery sector, and I imagine folks would say across industry.
So not all of us get to be Amazon, but that echoes some of what Jim Donaldson was talking about, of, you know, de-investing in large formats, reinvesting in things like small formats, you know, old school capital de-investing, but then, you know, technology and other models. I'd love to hear, you know, what kinds, as you are out there, what kinds of innovation or other opportunities are generating interest for investment outside of these sort of giant examples that you're talking about, Scott. So, you know, and Scott, if we only have like 2 minutes left, so if you just have, you know, a brief statement of just 1 or 2 categories that are interesting to you. Let's start with Alan, and then we'll end with Scott. Kellan, you come after Alan. So just quickly, if you can name something, that'd be great.
Yeah, I mean, in our world, in this logistics world, I think 2 factors that are playing more into our investment decisions these days are resilience and safety. So while, you know, speed, price, and optionality or choice were the primary drivers, things that brought those to the forefront pre-COVID, I think the added layer of businesses or technologies that sort of produce or generate resiliency within the supply chain and within businesses, and also encourage safety going forward, I think are 2 new themes for us to follow in.
Kellan, how about you?
Said a little differently, we're really excited about technologies that enable business continuity. And, you know, everyone always talks about Zoom as the key workflow or communications platform, but what about companies like DocuSign, which if you can't go in the office, sometimes it's hard to sign and fax a document. So really technologies that enable business continuity, because a lot of enterprises are planning for scenarios like this in the future and preparing them not just for the current COVID, but for future work from home and potentially disruptive situations.
Excellent. Well, listen, I think that is time for us, but I want to thank all of you for your different perspectives on this. Good luck raising and deploying capital out there in this really, really interesting environment. So next, I'd like to hand it over to who we've already heard from, thinker, writer, commentator, and comment guy, Kevin Koop, to lead a discussion of the customer experience revisited. Thanks again.